So if you are a serial entrepreneur or a veteran business owner, or you're simply someone that wants to leave the corporate world to go off and do your own thing, you may struggle to find the cash that you need to fund a new venture. Generally, liquid assets like cash or securities are either tied up in the business or in a retirement account, which makes it difficult to access before age 59 and a half. But for business owners under the age 59 and a half who have accumulated substantial assets in tax-deferred accounts like an IRA or a 401k, there's actually a way to fund a business with retirement account assets without incurring taxes and penalties. And it is called a Rollover for Business Startups, or a ROBS. Now, a ROBS is more of an arrangement than it is an IRS-defined retirement account. A ROBS is essentially a method in which a business owner can utilize funds from a tax-deferred account to provide capital to their business without incurring withdrawal penalties or triggering a taxable event. So how this works is the new business venture is set up as an C Corp so that it can issue shares. Then a 401k plan is established for the company. And at that point, you, the owner, can roll over your tax-deferred funds from an old IRA or a 401k into the 401k of the new company, and then use those funds to purchase shares of the new company, thereby providing cash to the business with tax-deferred money without any taxes or penalties. So basically, instead of using your 401k to invest in Apple, you're using your new 401k to invest in your own company. Now, the IRS does not identify this as a tax avoidance strategy, but it is often scrutinized by the IRS and therefore requires pretty precise planning. So before we get into the risks of a ROBS, I want to quickly look at some of the benefits, some of which I already mentioned. But the primary benefit to using this strategy is that you can avoid taking out a loan or raising outside capital to fund a new venture. And you can do this without incurring any tax consequences. You can basically utilize funds that you've already saved. So this means no impact on personal credit and no paying interest. It also means that when you sell your business, gains from the sale of that business can be tax deferred since the shares are held within the retirement account. Now, of course, these benefits sound great, but there are some sizable risks. So first, this opens up your business to a higher risk of being audited. Now, this is a permitted transaction. It's allowed by the IRS, but the IRS looks closer at these businesses to ensure compliance. And if the IRS standards aren't met, that could mean heavy taxes and penalties for you, the business owner. It's also quite an administrative hassle to establish and maintain. Like I said, your business needs to be set up as a C Corp. You have to establish a 401k and administer that, which comes with its own compliance standards. Now, a ROBS provider can help with all of this, which I'll get to in a bit. But utilizing a ROBS provider can be costly, and if anything goes wrong, you're still on the hook as the owner of the business. And then finally, a big risk is that if your business fails, the retirement funds that you used to fund that business is gone. So depending on your situation, this could jeopardize your personal retirement plan, and that's a risk that you're going to have to seriously evaluate. Now, fortunately, ROBS providers exist to help establish and maintain the ROBS under the appropriate standards. Most providers will help with a lot. They'll help you set up the corporation, set up the 401k, issue the shares, manage the ongoing regulatory filings, but you pay for it. So on average, the upfront cost is usually around $5,000, and then monthly retainers or monthly maintenance costs are between $75 and $150 per month. But having a team of experts to monitor compliance is usually worth it in these situations. So some popular ROBS providers are Guidant Financial. They're probably the most recognized one. Benetrends, Pango Financial, Business Funding Trust, My Solo 401k. There are others out there, but those are the popular ones. Now, before you go off and try this, I highly recommend talking to a professional first. This type of transaction, while it can be very useful in some situations, comes at a risk. Trying to execute this on your own could mean having to work for many years past your anticipated retirement date, or worse, having to pay the IRS more than you need to. So if you have questions on this, feel free to reach out. But I hope this was helpful. Have a great week.